Hey, well, greetings and salutations, everyone, and happy the last Monday of the month of September. We are in for a real special treat tonight. Of course, I'm Walt Leska, President and CEO of WSLG, Wealth Leadership Strategies Group, and Jeff Moore is the National Sales Manager of American National, and he has been with them over 16 years and been in the industry almost as long as I have, 31 years. His experience in the industry, as well as, of course, what's going on in American National, and what we're doing and specializing in planning for college funding. This isn't his first rodeo either. So he's going to give us a great presentation. I'm looking forward to hearing it myself. And so take it away, Jeff. Thanks for being a presenter.
Okay, thanks, Walt, and good evening, everyone. This is Jeff Moore. I am with American National, as Walt said. Tonight, we're going to focus, so we don't get into too many things, we're going to focus primarily on American National's indexed UL, called Signature Indexed UL. But for starters, I do want to give you a brief intro to the company so you know more about us and you can share that with your clients. We have straight A ratings with AM Best, the largest rating agency and the oldest in the industry, as well as by Standard & Poor, commonly known by many folks out there. And then we also have a very strong rating for Weiss, a B rating, which for Weiss is an A with anybody else. Our financial capital situation is one of the strongest in the industry. Even though our size may not be the largest, it is one of the largest. But the most important thing is the 20% plus ratio of excess or surplus to our consolidated asset base. That gives us the financial wherewithal to maintain consistent interest crediting and strong products, which is what you're going to see tonight. Our A rating with AM Best, one of the oldest and longest standing records in the industry. We have been A or higher consecutively since 1941, 77 years. Longer than all the companies out there. There's only two other companies that match our track record. We hit the 100 billion of life insurance in force last year. That's a huge milestone in the industry. Very few companies have hit that. Usually just the big mutual companies. Walt and I both came from mutual companies. We got in the industry 30 plus years ago. And you typically don't see that in the non-mutual or independent side. So that's a big distinction. Forbes, third-party distinction. Forbes does a ranking of the most trustworthy companies every year. In my 16 years with Aneco, this is the third time we've been on that list. So I'm sure we've been on it longer, more times than that. Just shows you that it's a testimony to our financial strength and our integrity and transparency in how we deal with clients and how we manufacture products. Now, it all starts with the underwriting. You can have the best product on the street, and I think you'll see that we do have one of the best IULs in the marketplace. But if you can't get the policy issued, you fall far short. We have accelerated underwriting programs out there to help you do just that. We'll start with the two, and that is Express or Underwriting Express and the newer Express Plus. Now, on all your cases, ages 0, the youngest, all the way up to 65, through 249,999, so just shy of $250,000, the case is considered Underwriting Express. You don't have to do an electronic application. However, if you do an electronic application, it goes into our smart underwriting queue. They run the MIB and the script check like they would on any case. And if everything checks out, it doesn't even go to an actual live person. It goes into the computer approval queue and it's done within 24 hours. So we call that smart underwriting. Right now, and the best class, by the way, the best underwriting class in this lower face amount is standard. And of course, if they have any issues, we would rate accordingly. But 80% or better of those cases go through non-medical underwriting. no exam, no labs, no APSs. We don't do any additional checks beyond the application and the normal MIB and script. We run an LRC, that's a risk classifier, and right now we are running a tally of about 80%, 8 out of 10 cases are approved within a couple of days non-medically. Now, if you have larger cases, 250,000 and above, depending on the age, we can go as high as $1 million face amount through age 50 or $500,000 through age 60. Those cases do have to be an electronic application to qualify for this Express Plus, but all rate classes are available. So you get a young, healthy individual, you could get preferred. We got two preferred class, actually three preferred tiers. You could get one of our preferred tiers. And because that's a higher face amount, a little bit more involved, we're getting about 40% approved non-medically. Doesn't mean 60% are being declined. It just means the other 50-60% are just normal medical underwriting, where we would potentially need a medical exam, paramed exam, blood, HOS, and so forth. So 2 ways to help expedite a good chunk of your business and make it non-medical underwriting. Now, for those cases that do end up triggering something and they require medical underwriting, we have over 30 different medical conditions and several occupational factors where we can actually improve the rating, improve the offer. Anywhere from ages 20 to 60, up to 5 million of face amount, and that's pretty much all products, but our focus, of course, tonight is the IUL. We can improve some cases that maybe are standard, but otherwise could be preferred if it wasn't for a minor issue. We'll bump them up 1 or 2 levels into our preferred class. If they're no worse than a table 2, but they are substandard, we may be able to shave that substandard rating to a standard. It's automatic. You don't have to request it. And last year alone, we did 759 cases in our Eagle Advantage, our concierge service, and over half of those cases ended up being preferred. So several ways to improve not only the speed of underwriting, but the underwriting offer you get on your signature indexed UL business. Now for the main attraction, we'll jump into the IUL. For starters, we do offer a bonus version of that. I'm not going to go into a lot of extra effort on it because the product is identical. We call it Signature IUL or Signature Plus. Now, Signature Plus is basically the Signature IUL with slightly lower caps on the strategies. And in exchange for that, there's a non-guaranteed bonus that starts crediting after the 10th year of 1%. I say non-guaranteed because it is subject to change. Now, we've had it out for 3 years and never changed it, but that is a possibility. That said, probably about 75 to 80% of our IUL business is the standard Signature IUL, which will be the focus of what I talk about tonight. But regardless which way you go, bonus or non-bonus, the Signature IUL is issued anywhere from 15 days old or age 0 up to 85, age nearest birthday. Minimum face amount is $25,000. Very short 10-year surrender period. And I've got it circled there, no surrender charges on face reductions in any year. What that means to you, and I've got a slide or two to show you, they can actually make a reduction in the face amount if they had to make a policy alteration, even in the 2nd or 3rd year when most policies, ours included, are still within the surrender period, they can reduce the face amount. More on that later. Minimum guarantees, the fixed account, because we have a fixed crediting strategy, can never be less than 2.5%. Any of the strategies involving a cap rate, which are pretty much the other 3, can never be less than 3. But as you're going to see with our crediting history, we've never gone anywhere near, even in this low rate environment, we've never gone anywhere near the contractual guarantee. Now, that said, most companies, their minimum cap rates on their indexing strategies is typically 1%. So we are higher than the industry anyway. But the lifetime look back guarantee, which I'll center on as one of my positioning points, is very strong. So keep that in the back of your mind. 2.5% on death or surrender. That's a minimum guarantee contractual. Policy loans are available immediately. As long as there's surrender value in the policy, they can borrow either fixed loans, which are non-par loans, 0% net interest, or variable loans, which are participating loans. And I'll go into the more detail as to how one works versus the other. But note, they can switch on any policy anniversary up to 5 times in the life of a policy between loan types. If they have a variable loan and they want to switch it to a fixed loan without paying it off, they can do so. And they can go back and forth several times. Now, some of the key riders and benefits. And again, another one of the positioning strategies is blending term on your IUL. And our very competitive signature term policy is available as a rider without a policy fee for the 10, 15, and 20-year term inside the IUL. And they can blend it up to 4 times the IUL base face amount. Okay, up to 4 times. And that rider has all the same conversion privileges of a standalone policy, and it can actually convert to just a simple increase in the face amount on the IUL, rather than having to convert it to a separate policy, which most companies require. We offer disability waiver of minimum or stipulated premium. We have a children's term rider, which covers all the kids in the household. And then we offer a rider that's very common on whole life policies, not as common on universal life, certainly not on IUL, but this is great for children policies. It's called guaranteed increase option. And this guarantees future purchase of additional amounts of insurance without any underwriting down the road. It would, of course, be at current age, but it basically tells that child or that child's parents who are buying the policy today that that child's got at least half a dozen different ages in the future where they'll be allowed to buy additional amounts of life insurance in the form of face amount increases without ever going through underwriting again. And based on the IUL and the maximum on that rider, they could take the maximum amount, which would allow them on those 6 age anniversaries to purchase up to $150,000 of additional coverage without evidence of insurability. So that's a huge rider for kids or young adults. No cost riders, the living benefits, which we'll give you more detail on, and overloan protection. Now, overloan protection, similar to what you might think about when you look at a checking account and you get overdraft protection. You write a check for more than you have in your checking account, and rather than bounce the check, the bank covers it for you. Well, Anaco kind of does the same thing. If your client overdrafts their policy, in other words, they borrow too much on the policy, and maybe there's a period of low interest performance or low index performance, and they're not adding enough premium in, maybe they reduce their premiums or stop paying premiums, and the policy enters risk of lapsing, that overloan protection benefit can be requested, and it basically converts the policy to a reduced paid up policy. We basically take the cash surrender value after lowering the death benefit to pay off the loan, and then no more premiums, no more distributions. They have a reduced paid up policy. So maybe they had a $500,000 policy. It was in danger of lapsing. We triggered the overloan protection clause, and now they've got a $100,000 paid up policy as opposed to a lapsed $500,000 policy. This is a must-have rider or clause on any IUL. Some companies don't have one. So make sure, anytime you're looking at an IUL, especially in comparison with ours, that's a definite factor you want to compare. Okay, indexing strategies. Okay, as I said, we've got a fixed account. And these are all one-year strategies, by the way. Fixed account, one-year interest rate, among the highest in the industry. It's currently 4%. It's been 4% for quite some time. And then we have 4 indexing strategies, and they too are all one-year strategies. 4 simple indexing strategies, 100% participation in the S&P 500, each one of them. And the way they are structured, as you're going to see, they are built for basically up, down, or even sideways markets. Okay, imagine that, an indexing strategy built for a down market. No minimum allocation, and they can reallocate every month, not on the anniversary date like everybody else. Anaco says in any given month, a client could request to reallocate their indexing strategy. So if the market has a major change, the economy has a major shift, and the client says, I need to reposition my crediting strategies, they can do so without waiting another, who knows, 8, 9, 10 months until the anniversary rolls around. No, they don't have to wait. 5 total strategies then with Anaco, including the fixed account, to deliver growth in all market situations. All funds will sweep into the indexing strategies as soon as 1 year's policy costs are met. So we are sweeping monthly. And what that means, most companies, us included, in indexing policies, the money comes in and it goes into a fixed bucket or fixed account with everybody, all companies out there, and the insurance costs, policy costs, cost of insurance, all those things come out of those premiums. And once those costs are met for a year, then the company goes ahead and frees up those funds to index according to the client's indexing strategies. We do it monthly. Some companies only sweep on quarterly, some semi-annual, some only on the policy anniversary. That's important to performance. And it's also the reason why we tell clients, never minimum fund an IUL. Always solve for at least target premium. It's called target for a reason. Got to be on target, or pay above target, which is called max funding, as many of us know. But Anaco's got a proven track record, not just of glossy brochures and hypothetical performance record, but an actual performance record that leads the industry. And we're going to look at that with each strategy that we offer, starting with a fixed account. Now, fixed account's pretty straightforward. In example 1, if the market's up 10%, doesn't matter. If you got the money in the fixed account, you get the fixed interest rate. Currently, that's 4%. Same goes if the market doesn't change at all. You get 4%. If the market goes down 10%, you get 4%. This is the all market winner of a strategy. If you're in a situation like we are today, where the market is breaking records every day, might not be a bad idea to have some of the clients' money in the fixed account. They always say, always have some money in cash, keep your powder dry. Well, this is your dry powder strategy. It's performed well over the years. The highest it's ever been in 7 years is 5.5%. The lowest it's ever been is where it is today. So we're kind of at the low. It's only changed 1.5 in 7 years. It's not bad. And if you take the annualized performance over 7 years, nearly 4.5%, not bad. Next strategy is probably the most conservative of the of the 4 indexing strategies that we offer. And I say most conservative because it has the highest, not just with Anaco, but in the industry, the highest positive correlation to returns. And what I mean by that is the market only has to be flat or better to hit the maximum return on the strategy, because it's either all or nothing. If the market is flat, they get the current specified rate, which is 7.5. If the market's up at all, they get 7.5. Only if the market's down do they get 0. Over 75% of the time on a 10-year rolling period, the S&P 500 has been positive. So this one's got a higher percentage chance that it's going to deliver a positive return correlated to the S&P than any other strategy out there. History's proven it. And annualized over 7 years with Anico, we've paid out nearly 6.3% annualized rate of return. And this is the only indexing strategy in 7 years that we've never changed the rate. It was 7.5 the day the product hit the market. It's 7.5 today. It's never changed. This is a good one to have in a market that we're in today, where you've got basically 2 out of 3 chances of getting a positive result. Now let's talk about the traditional cap approaches. This one is cap strategy number 1. Highest possible cap with still the underlying protection that if the market goes against me, my worst case outcome is 0. 0 is my hero. We call this high cap, 0 floor. Highest it's been in 7 years is 14%. Lowest it's ever been is where it is today, 11.75. It's only changed a little over 2% in 7 years. Not many companies can say that. The annualized performance based on Anico crediting, over 9%. That's pretty impressive. The second cap strategy is what we call volatility control. Market goes up, they make money. Market goes down, they still make money. The market goes sideways, they make money. Worst case scenario, they can never get less than a positive 1.5%. The market went negative, they get 1.5. If the market goes up, they can get up as much as 8.75 today. The highest this strategy has ever delivered is 10. The lowest, again, it's where it is today. It's only changed 1.25% in 7 years. Now, other companies do have a volatility strategy similar to this in their products, but most of their minimum return return is 0.5% or maybe 1%, just barely above 0. Having a 1.5 minimum is better than most companies out there offering a similar strategy. An annualized return over 7 years, over 7.5%. Not bad. The last one is what I call the highest growth possible, uncapped strategy, but with an upfront spread. Those of you that have managed money or maybe purchased shares of a front-end loaded mutual fund are familiar with this type of pricing. It's called a front load or a spread, where the first few percent of return are absorbed by American National in the spread. Once they get above that spread, the sky's the limit. There is no cap. So in this case, using the example below on the lower left, if we assumed a spread of 5% and we assumed an index return that year of 20%, that client would get 100% of 15, or basically a 15% rate of return. They give up the first 5, but everything else beyond that they get. Now, if the market goes down, they get 0. Annualized over the last 7 years, we've done nearly 7.25% on that strategy. And I wanted to point out the highest year we actually had was just a few years back, 24.85, just shy of 25%. So this is the one that can shoot the lights out if the market really zooms. So it might not be a bad idea to always have a little bit of that strategy indexing going into that high return strategy, just on the off chance that we hit one out of the park. So those are the strategies with Anico. As you can see, all markets up, down, sideways. We can hit a basically at least a base hit, if not better, with every year, every market we enter, resulting in that tax-free access for income. In other words, tax-free accumulation, tax-free income. Now, how do we take that? How do we take that tax-free income? Because it's going to be a policy loan. That's what allows it to be tax-free. If you borrow money from a bank, they don't send you a 1099 for the interest or for the loan amount. It's a loan. You're making payments on it. Well, here you don't have to make payments. Now let's start with a fixed loan. Day one, year one, if they had a dump in that went in and they created cash surrender value, and maybe later in the year they wanted to borrow some money out, no surrender charges are applied against the loan. I mean, it's going to come out of the cash surrender value, so they're already figured in. So we look at the available cash surrender value, and if it's a fixed loan, whatever amount they borrow, we create what's called a loan collateral account, and the amount goes into that they borrow. We also create a loan collateral interest account, and the same amount goes into that account. We charge 6% interest at the end of the year on the loan collateral interest account, and we credit 6% interest in the loan collateral account. The two wash each other out, and the net interest cost to the client is zero. On death or surrender, the loan is paid off against the remaining cash surrender value or death benefit. So it kind of acts as a lien, like you take out a second mortgage on your house, it acts as a lien against the house. In this case, it's a lien against the policy, but you don't have to make payments, and the net cost of the interest is zero. This is available day one. Some companies call these zero wash loans preferred loans, and they're not available till the client gets beyond the surrender charge period, which with many companies is in excess of 10 years, 15 in most cases. With Anaco, nah, first year, second year, doesn't matter. Client can access it as soon as there's cash surrender value. Now, if they want, if it's a low interest rate environment like we're in today, where the variable loan rate is about 4.5%, they can actually take a participating loan where the money doesn't leave the policy and go into a separate collateral account. In other words, it remains in the policy, allocated to the remaining the various indexing or fixed strategies that the client chooses, and it continues to earn interest based on those strategies. So using an example where maybe the client borrows $10,000 at the beginning of a given year, and let's say that the interest rate on the loan for that year is 4.5%, and they earn with the respective allocations 10%. Well, that $10,000 that they borrowed out actually earned a net return of 5.5 because we assessed 4.5% interest against the loan, but we credited 10%. Not a bad trade-off. So, and if that variable loan rate creeps up, because it's a floating rate, and it can float up to statutory maximums. We don't have an artificial maximum like some companies, because that actually puts pricing restrictions on the cap rates and actually works against the client in the future. So we don't do that. We've got a floating rate variable loan, and right now rates are pretty low. Highest it's ever been is 5.75. Right now it's at 4.5. But let's say that rate did creep back up towards 5.75 or even 6. And the client said, I'm afraid rates are going to keep going up. They can switch that variable loan to a fixed loan on any policy anniversary. Just a simple one-page form called the IUL Policy Service Form, where they request either to take a loan, request to make loan payments, or they request to recharacterize an existing loan from variable to fixed or fixed back to variable. They can do that up to 5 times. Now, performance with any investment, we've always been taught, investments perform better if the expenses are lower. Well, IUL is not an investment, but the same principle holds true. So Jack Bogle of Vanguard Funds would agree. An indexed UL, indexing to the S&P 500, all things being equal, one's going to perform better than another if the expenses are lower. And as you're going to see, Anaco's got one of the lowest policy costs of an IUL in the industry. And many reasons for that, but one of the main reasons I think you've already seen with our indexing strategies is they're all based on one index, S&P 500. So our indexing costs, which are a large chunk of IUL, are among the lowest because we're only buying options on one index. We don't have all these home-baked indexes that sound really glamorous, but that nobody can really track or show consistent history on. And many of your clients don't even know what makes up those indexes. Aneco says S&P 500. Everybody's heard of it. Most people know what companies are in it. And because we use it, our policy costs are lower, which helps lead to future performance. What you're going to notice here, and this is a snippet of a expense report, which you can actually create within a normal illustration. You just go to reports when you're running an illustration and select the first one, which is expense report. But I've got them circled here, the various components and what they result or what they're for, and we actually have that spelled out in the narrative in the illustration. But notice that the current and the guaranteed are the same. That's one of the gotchas that a lot of companies have, is their guaranteed costs are significantly higher than their current. And with American National, what you see is what you get. The current that we're projecting is also the guaranteed. There's no smoke and mirrors with Aneco. And a majority of the cost, nearly 2/3 of the costs, drop off after 10 years. When that surrender charge period goes away, most of the other policy costs go away. The only ones that continue are the actual cost of insurance. That's, the basic cost of any life insurance policy, even a term policy. It's based on how old the client is. That goes up over time. But the premium charge, that's going to continue as long as they're paying premium. But that's it, just those two charges. All the other charges are gone after 10 years, over 60%. That's why you see long-term performance with Aneco significantly outperform most other companies. And I did a comparison, or rather Broker World did back in July of this year. They had a cross section. They didn't mention company names. They just put in a fictitious, company A, B, C, and D in terms of the name, but they took leading competitors in the indexed UL marketplace and they listed what their policy costs were as a percentage of cash value at age 65. And they did it as a cumulative, total cumulative charges at age 65 relative to the cash surrender value projected at age 65. And I thought, I'm going to run Aneco on the same example they ran and do a comparison. Well, as you can see, we came out at 7%, and that's at the low end of the range. And these are some of the biggest competitors per the article in the industry. So we compete with the big boys, and with the lower policy costs, all things being equal, which when it comes to the indexing world, the S&P is going to do what the S&P is going to do. And if we're all pretty much indexing to the S&P or some other index, it's our policy costs that are really going to drive performance. And Aneco's got among the lowest in the industry. Now, I mentioned face reductions, flexibility. When Walt and I got in the industry, Universal Life was in its infancy. And many of you may be veterans, been in the industry 25, 30 plus years. IUL was just a myth at that time. We didn't have today's present day IUL. But Universal Life, we were taught, is flexible compared to whole life, where you can't make as many changes in premium and face amount. Well, Universal Life, you should be able to make those changes. Aneco believes that. And with our indexed UL, you can make a face reduction at any time, even in the first year if you wanted to, without a penalty to the client. Most companies don't allow face reductions during the surrender charge period, because the way these are done, in order to prevent the policy from becoming a mech, when you do a face reduction, you typically have to charge the surrender charges and pull a commensurate amount of cash surrender value out of the policy. Otherwise, you'd have too much cash left in the policy versus the face amount, and it would become a mech. Well, Aneco says we don't have surrender charges when it comes to a face reduction. So there's no penalty to the client. They can make a face reduction. They're not penalized. Maybe they got a situation where, they lost a job, had some life situation crop up. We had a client a few years back where it was a school teacher. She got pregnant. It was like in the second or third policy year, and they couldn't keep the premium level where it was to max fund the policy, but they didn't want to lose the policy altogether, so they did a slight face reduction to the level where the premium they could afford would still adequately fund the policy. With most other companies, she'd have been out of luck. With Aneco, that's not the case. Here's an example to prove that. Face reductions at any time without penalty. And this is in the 5th year, you've got a face amount of $750,000, and the client decides to make a face reduction down to $500,000. Well, look at the accumulation value and surrender value columns. They continued to go up in the 6th year. We did not take a penalty from the client. We did not reduce the values. Now let's look at some positioning ideas. Kind of wrap this thing up and show you where Aneco really sells. Weatherproof your IUL. Okay, we all hate storms. Well, how about the storm that wrecks your IUL? Could be a low interest rate storm, could be a volatile stock market storm, whatever it be. Wouldn't it be nice to have a cumulative guarantee that says the policy interest rate of 2.5% will be credited for the entire duration of the policy, regardless of what happens? Well, we have just such a guarantee. They're going to get the greater of actual performance, or if the cumulative performance at time of death or surrender doesn't measure up, the worst case scenario is the client gets 2.5%. Other companies don't have this type of a look back or cumulative rate guarantee. Now, some do offer a cumulative guarantee on the rate, but it's typically a very small 0.5%, 1%. We're 2.5%. And with that guarantee, you could have situations like this. This is just a plain Jane illustration, 35-year-old standard on $250,000 a face amount, paying a little over $200 a month. So about target or a little over target. And you can see here that on the guarantees, that's assuming the guaranteed highest cost of insurance, highest policy cost, and assuming no other return other than the 2.5% that I've circled there in the middle. This policy runs 38 years on the guaranteed values. If we use the current non-guaranteed cost of insurance and other policy costs, take a look at that. That runs 51 years. This is without some secondary no lapse guarantee feature that you may have to purchase to get with some companies. Aneco, it's embedded in the policy. It's an underlying secondary guarantee that says you're going to get either the index performance your policy does, or worst case scenario, your backup plan, 2.5% for the life of the policy. Nobody else offers this. Now, for that client that likes the idea of indexed UL, they want to get into it today, but maybe based on their coverage needs, they can't afford the full amount of coverage they need in an IUL. But rather than saying, well, it's all or none, why don't we use term insurance to bridge that gap? I call it life gap coverage. And using the signature term rider, 10, 15, or 20 year, you can blend that in the IUL within the policy. You only have one policy, only one policy fee. The IUL is for accumulation. The term is for extra coverage. That'd be for mortgage, for college, whatever they need that extra coverage for. And it could be temporary, which is ideal for a 10, 15, or 20 year period. Here's how it works. If we take an individual, in this case, it's a male, and I got age 30, 35, 40, 45. We're assuming a $1 million coverage need, and we're assuming an increasing death benefit, and we're assuming target premium, monthly pay. Look what the difference is in monthly target premium, which is what we need to max fund this policy. Look at the difference. If we take a 40-year-old that says, I really can't afford over $1,000 a month on this $1 million IUL. Love to be able to do that, but I can't do it. But I need $1 million of coverage. Well, how about if we do $500,000 of 20-year term and $500,000 of IUL? We can knock $400 a month off that cost, nearly $500 a month off that cost. We can save the client $500 a month using term And since that term rider is fully convertible for 20 years, guess what? When you do convert any or all of that, because you don't have to convert it all, but the client has 20 years to convert some or all of that rider, and think of it for yourself is it's a deferred commission, because we're still going to pay full commission up to target if and when they convert down the road. So that other $500 of target premium that they couldn't afford anyway, that you're not getting paid on today, you'll get it later. But guess what? You'll have a happy client rather than a non-client who says, I can't afford $1 million IUL. So you can make it fit, and you can blend, like I said, up to 4 times with term versus IUL. So maybe you do a $200,000 IUL and a $800,000 term rider. However it works to make it fit, and then do gradual conversions over the next 20 years to make it work. You got tax-free retirement benefits, obviously, as we talked about with the loan feature. Currently, the loan rate is 4.35, very low, okay, very low. And think of it as a tax-free retirement income stream with a tax-free death benefit that will self-complete a qualified plan. You know, most qualified plans, 401ks, and that come up short that if you haven't saved enough when the primary breadwinner dies, then all that survivor family member is going to get is what's in the plan. Well, this one basically self-completes it, pays a tax-free death benefit. So it's got a survivorship feature that most qualified plans don't. It can be a good supplement to a qualified plan. If you're working with folks that are putting money away for retirement and they don't want to stop doing what they're doing, and maybe they shouldn't. There's some great qualified plan options out there. Problem is that many retirees today are reluctant to draw down their savings when they get to retirement because they don't want to outlive it. Statistically, and I got it circled, this is a startling statistic, but those with $500,000 or more spent less than 12% of their nest eggs in the first 20 years of retirement. Why? Because they didn't want to spend too much and leave their loved ones without anything if they died, or spend too much and run out of money before they died. So having a backup plan, a supplement with Signature IUL makes so much sense. And of course, we're talking about college funding, so I'm going to end on college funding as a sales idea. And so doing, I'm not going to necessarily say that college funding using some of the traditional, custodial accounts or 529 plans are bad. Kudos to parents and grandparents who have the foresight to start early and start putting money aside in some of these programs. Nothing wrong with that. So how about looking again at the Signature Indexed UL, just like we did with retirement, as a supplement? We max fund early and try to build values in that IUL, and maybe borrow some of those values from the IUL to help supplement the college costs, supplement what's in that 529 plan to pay for books, maybe pay for student housing. We're not going to pay the whole tuition bill in all 4 years with our IUL, but we're going to help shave off some of those costs. And if something happens along the way, parent dies before the kids ever reach college, guess what? That savings plan is fully funded with a death benefit. Same in case of a catastrophic illness with living benefits. So look at it as a supplement to a 529 plan. And the flexibility of it, some of the biggest ones, and I know many of you are probably familiar with this, but if you don't use the funds in a 529 plan or other college savings programs, the underlying account holder gets a 10% penalty. So you're kind of restricted on what you use the money for, not with an IUL. The self-completing funding, you don't have that with 529 plans or most other plans. If the breadwinner dies too soon, as we just said, what they get for college is what's been saved up to that point. And for those trying to get FASBA or other financial aid, many times what's in a 529 plan or other trusts and custodial accounts for the students are considered accountable asset, which basically means they could be disqualified for financial aid. IUL, life insurance, and annuities are not accountable asset. They will not count against them for financial aid. So with Anaco's IUL, You've got 4 indexing strategies for up, down, and sideways markets. You've got a guaranteed lifetime backup or look back of 2.5%, so they'll always have a positive rate of return, and that's compounded, by the way. You can blend term with the base policy in the IUL to make sure that you find the right blend of affordability and coverage to meet the client's needs. One of the shortest surrender periods in the industry, with the flexibility to make reductions in the face amount at any time. 2 easy and switchable strategies for taking loans. And I didn't mention this before, but if you are doing a 1035 tax-free transfer from an old policy, an old whole life policy maybe that's got outstanding loans, Anical is one of the only companies out there that accepts 1035s from other companies with outstanding loans. All this with the underlying protection of living benefits. We've got more living benefit critical illness triggers than any company offering critical illness. 16, 13 in the state of California. We offer partial and full settlements, even multiple settlements in the same year. We include critical and chronic through Table 4 or a flat extra $5 per thousand. Terminal, of course, is offered on any policy, regardless of rating. And we have paid out just in the last 18 months alone, all of last year and the first half of this year, over 100 or nearly 100 claims for over $7 million. So Anico not only promises, Anico pays. Now, just a quick, since I know we got some California viewers most likely, outside of California, we have that $2 million limit for all 3, critical, chronic, and terminal, through age 65 at time of application. Now in California, it's actually through age 64 at time of application. And the caveat is if they're over age 64 at time of application in California, they will only have terminal illness. Okay, so that's California variation. Outside of California, they would still have $1 million coverage on all 3 living benefits if they're 65 or older. So that's the main difference. If we're talking IUL, they're going to have all 3 living benefits, bottom line, through age 64 at time of application. The term or term riders, if they're including a term rider, we do not currently have the chronic illness in California. We're still addressing that, so that's to come down the road. And there is a supplemental application for the critical and chronic illness that will print or be populated in an electronic application automatically. The underlying qualification there to make sure you have critical and chronic is they must have health insurance. If they indicate that they don't have health insurance, that's an automatic no-no in California. And if they answer yes to any of the Part 2 health questions on the application, those will be disqualifiers in many cases for the critical illness and in some cases for the chronic. So those are the 2 main things. But it's possible to get a policy issued in California where you may have critical but not chronic, but you'll have critical and terminal. Or maybe have a policy where you'll have chronic and terminal but not critical. But you know, it'll be spelled out on the application when you take the app with the client. The illustration you run on the IUL will actually do a hypothetical. It's not going to guarantee this is what we're going to pay, but it gives the client an idea. Based on the illustration you're running, it customizes it and says, these are, based on the payout, how we do the calculation, which is basically, it's an impaired underwriting assessment measured by life expectancy, both before the impairment and after. If normal life expectancy for a male age 60 is 25 years and the impairment significantly reduces that, then we're looking at a moderate to severe impairment, and that's about how much the client could expect in a payout. So this will populate with any illustration you run. If you have questions going forward, I am your main contact at American National. Walt, of course, at Wealth Strategies, but here to help you. And then to support me or supplement me is my field of internal field support, basically internal wholesalers. We call them Field Support Center. You call that toll-free number and you hit option 1, and then there's about 6 or 7 different areas so you can pinpoint exactly who you need to talk to. Maybe it's illustration questions or help. Maybe it's product questions, ordering supplies, you name it, you'll get the right person for the job. Thanks for your time tonight. I'm going to flip it back over to my good friend Walt.
Hey, Jeff, thanks so much. Really appreciate your presentation. Absolutely amazing. So, guys, you see now why we strongly recommend and obviously use American National. We've looked under the hood, and you can see it's an amazing setup for living benefits that many other companies don't do, and they really don't shortchange the client. And I've always said we're in a relationship business, and we've got a great relationship here with Jeff and American National. Any questions? Feel free to call Jeff. I've actually called Jeff, and he's been extremely helpful. And when he's busy, I've called the field support center, and they've actually answered the phone pretty quickly, and were wonderfully helpful as well. So with that, we're going to close out. Just remember, we really are offering value, and I mean, the last 50 minutes, Jeff's talked about living benefits. He didn't talk very much about death benefits. We're talking about living benefits during the entire life, of how flexible and competitive this is. I mean, my gosh, some of the minimums in the plan are higher than some guarantees in other plans I've offered. So this is a strong option and outfit. Jeff, thanks so much. Everyone have a great night. And God bless. We'll catch you next Monday night. And we're going to have Jeff back and down the road, and keep the learning going on. God bless everyone.
Thank you.
Thanks, Jeff.